Slightest of cracks seems to be emerging in some of the bull case for the market. What we've seen over the last 2 weeks has been a serious beatdown into value stocks. But what we got today, and adding on to a few sessions of weakness in NVIDIA, is a little bit of slippage in some of the tech stuff that's been really powerful. Obviously, the trend has been extraordinary, and you're going to have to get a much more severe price correction in the big tech companies to give it any second thought. So the green light is still very much on for stocks, but a yellow light starts to itch at my brain a little bit here if the S&P veers downwards closer to 6,000. We've held the range pretty good between 6 and 61. But if we start to break down from there, things could get a little bit more dicey, because keep in mind, if tech softens up, all the stuff in the rest of the market has to flip around and go the other way to even it out. And right now, nobody wants to touch the other stuff. Look at the ratio of value to growth right now. Just looking at a couple ETFs, SPYG versus V. V for value, G for growth. This is a chart that goes back to November 5th, the election move. Had the big pop in growth and value together, and then from then we had a major break. The last 2 weeks, of course, value has done terribly next to growth, with the spread now at 10%. That's pretty impressive stuff in terms of the growth resurgence. The market had been trading them pretty much in sync for the last couple weeks post-election, but now you've done this total reversal. This gap here is one of the worst short-term value performances that we've seen in the past decade. Really, you can only go back to COVID in 2021, where you saw that type of short-term bias toward the growth stuff. And again, as we talked many times, mathematically, that's almost favorable to the index, because you can have few names go up and keep the index flat. The catch, though, is that the other message that this is giving is that the value category overlaps with a lot of things that depend on the economy, which gives us a bit of a message that perhaps this big hope for an economic boom associated with the next administration is being rethought. Now, if that happens, then you've got implications that take us back to conversations that are a little bit more uncomfortable for investors, thinking about things like interest rates, regional banks, areas that have given us issues before. The chart of KRE right now is really needing to hold this gap. I mean, this is the post-election gap on probably one of the most important groups of the market still. The reason why it's important is because of the message that it sends. This is the area that scared people the most about the economy since post-COVID. And what happened after the election was a massive change in sentiment, a hugely optimistic view that everything that was going to happen, from deregulation to prosperity, tax cuts, whatever you envision coming over the next 4 years, the market in this gap told us that it will help put behind concerns of the past. So if we start to then erase that gap and this starts to sell off more, then that's the market telling you that it's lost this entire total change of heart. And that's a pretty big deal. So I want to watch the regional bank chart very closely. I want to see how the market responds to Jerome Powell tomorrow, who is almost certainly, without any doubt, going to cut rates the way the market wants. But if we continue to see interest rates rise, it might continue to eat away at this value story, and then you really got to hope that tech holds on, because it doesn't look like folks are ready to rotate back into the stuff right now. It looks really ugly, one of the ugliest it's ever been for the value trade. But the green light holds on stocks until tech breaks down further.